Hello people and traders, this is Shlomo Cooper and welcome on board for the journey that will take us to the week ahead. So last week the indices continued their trading range action, and the S&P 500, and I'll just take my laser mark, finished with a slight gains of 0.4%. The Nasdaq 100 was a little bit better, gaining little less than 0.9%. And you know, we got some decent earnings reports from Microsoft, MSFT. Also, PayPal was a great play on Friday, and just look on the surge from the opening till the close. It was just a one-way ticket up. And then we also got good earnings from KLAC, KLA Tenco, which were of a great help. But General Electric, although it was managed, to close away from its lows, session lows on Friday, it missed the estimates. Oil is steady, and we are going to visit oil in a couple of minutes, but a stronger dollar is causing issues. Halloween is still more than a week away, but financial assets put their zombie costumes, I may say, on early this year, and we see major equity averages meander around awkwardly and aimlessly. Let's get to the slides, and I'll just forward it a little bit. Alright, this is the right one. So the S&P 500 traded to an all-time high more than 2 months ago in mid-August. This is where my laser mark right now is pointing on, and then quickly went catatonic, trading in a range of less than 3 percentage points. Now, 8 years ago, in 2008, I recall, the S&P 500's average daily move was 3% per day on its way to peak of 4% that December. These days, we can't even get 3% in 2 months. Looking at the charts of the major US equity benchmarks, it is, a similar picture. And so the Russell 2000 that we see right now, and the same picture for the Dow Jones and the Nasdaq, they are all hanging around right near their August highs, pinned between their 50 and 200 day moving averages. While US stocks are in zombie land, the picture in international equity market is more mixed and differs based on whether you measure returns in local currency or USD adjusted returns. So we are going to see both measures. On the left hand side, we are going to see returns in local currency, and on the right hand side we are going to see the returns in USD adjusted. So like the US, the stocks 600 of the European market is stuck in a sideways range, but is nowhere near its highs for the year. If we will get to the FTSE 100 of UK, it has rallied hard since Brexit, with a gain of 11% since the Thursday of the vote. After taking the decline of the pound into account, though, it's actually down 8.8%. So just look what a total difference we have, whether we are measuring the stock market action of UK in local currency or in USD currency. Total differently. Due to the strong yen, Japanese stocks have been weak, but are looking to break free of the 200 daily moving average. In USD terms, however, the right hand side, Nikkei is consolidating right near its highs of the year. And let's get to Brazil, and the EWZ is going to be your ETF of choice should you want to take a ride with Brazil. Actually, we mentioned a couple of times Brazil this year in the Investors Club sessions, and Brazil is often, a proxy of emerging markets, and it has been one of the best performing global indexes over the last year in both local and dollar terms. And again, you can get an exposure in the American market to Brazil by just putting on your chart the EWZ, and what a nice ride. Actually, it bottomed early this year in mid-January. It traded for just below $17 per unit. Right now it's trading for 37.50, new year high. Great. Okay, moving forward, and the market maybe having trouble deciding which way to go lately, but from the lows earlier this year, we have seen some massive moves. A case in point is Amazon.com, and last weekend an article in Barron's had a really eye-popping statistics in it, and I looked at it, and that was that since its lows earlier this year, Amazon stock is up over 70%, and let's just take a look on Amazon AMZN. So that was the low of the year, trade for just over $450 per share, and right now it's trading for over $817 per share. Now a 70% gain in 8 months is impressive enough, but when you take the market cap of the company in account, and this is exactly what we are having right now on this table, Amazon.com has increased its market cap by more than $150 billion, and that is billion with a B, traders. So this table lists the biggest gainers in terms of market cap since the February lows. So since the S&P 500 low on 11th of February this year, Amazon, as we can see, is the biggest winner. Amazon is the biggest winner by a wide margin in terms of market cap gain since the February lows. Apple, which is going to deliver its earnings tomorrow, Tuesday, is the only other stock in the S&P 500 that has seen its market cap increase by more than $100 billion, actually more than $109 billion. There is, a heavy presence of technology stocks on this list. Actually, 7 of them are coming to us from the technology sector, who have benefited, from the strength of that sector, including 4 of the top 5. In total, these 20 companies account for a total increase of $1.06 billion in market cap, or 38% of the S&P 500's total gain. Let's take a look of what happened last week in the economic scorecard. So it was, a light week of economic data last week, but this week will be a lot more active with nearly twice as many indicators to contend with. So first of all, by taking a look of what happened last week, data last week was skewed to the downside, with weaker than expected reports outnumbering stronger than expected reports by a factor of 2 to 1. Notable misses were core CPI, housing starts, and initial claims. All are colored in red, and we had also strong beats like building permits and the Philadelphia Fed. The economic figures this week, which you can just get in our daily report that that we send our subscribers on a daily basis, and it will bring with it the initial Q3 GDP growth that is going to be published on a Friday, which will be, and analysts focus now a 2.5% increase. The latest reading on Q2 growth featured an annual growth pace of only 1.4%. Other economic figures that will be released this week will include the Manufacturing Index of Market, the Global Financial Information and Service Company, along with the Employment Cost Index, the Consumer Confidence Index. We are getting two of them, one on Tuesday and the other one on Friday, and we also get housing numbers. We are going to get new home sales on Wednesday. All right, let's go to China, and one area of the world where we have been seeing some improved tone in economic data is China. Overnight Thursday last week, a report on property prices in the country showed a continued acceleration in year-over-year, and this is what we are seeing right now on the slide to the left, and month-over-month price changes across cities in the country. And the number of cities reporting year-over-year increases in prices of new and existing apartments is at, as you can see, the highest level in at least 2 years. In addition to rising property prices, gaming revenues have also shown a meaningful rebound after 26 straight months of year-over-year declines in gambling revenues in Macau. Right now, prices have risen 2 months in a row to 7.4%. Chinese equity have also been building a base and slowly trending higher, even after adjusting for the weakness in the yuan, the local currency in China. This chart shows the Shanghai Composite in USD terms since the lows earlier this year, which is here. The index has been carved out a series of higher highs, and it's been going up steadily ever since. If you want to get an exposure to the Shanghai Composite, actually there are some very decent, very good ETF to rely on. One of the best is ASHR, right? ASHR, and here we can see the same picture of a trending higher price action. Still, it's below the 200 moving average, but you want to buy it below it, not above it. You know, this is where you are getting cheap prices. Okay, let's go to the oil and let's see what happened in the oil last week. Crude oil prices finished last week essentially where they finished 2 weeks ago at just over $50. And crude oil at $50 is looking a lot like the S&P 500 and the 2,100 points level from last year, acting as pretty significant resistance. My view remains that as long as crude trades above $40 per barrel, credit markets will view it as a manageable level. The continued drawdown in inventories, and this is what we are going to see in the next slide, at a time of year when actually we see inventories usually building. As you can see what happened last year in 2015 inventories, and what happened in the orange line, the average last 10 years, or since 1983 in the red line. So actually it's good that we continue to see declines in inventories, and last week's unexpected drawdown, actually we got a decline of more than 5.2 million barrels, where analysts were estimating an increase, a building of more than 2 million barrels, is also providing support to prices. So last week unexpected drawdown is bringing inventories levels close to where they were at this time last year, and this will be when we get a cross between the blue line, the 2016 inventories line, to and the 2015 inventories line. Let's get to the earnings season, and last week actually we started the earnings season for Q3 for real, And let's see let's just go through a couple of statistics. So we've now gotten enough data points this earnings season to update a few of our summary charts that compare earnings trends this season to prior ones. After another week of reports, the overall earnings beat rate, which is the percentage of stocks posting better than expected earning per share, has jumped up to 68%, which would be the highest beat rate since Q4 2009 if it holds, and that is unlikely, though we are just at the beginning, as I said. If we will take a look on the top line revenue beat rate, it has also increased from last week and now stands at 58%. That is, a relatively strong number compared to prior seasons over the last couple of years. And each bar represents here 1 quarter. And this will be, bullish for the market if it can stay near the 60% mark. Companies have been reacting quite positively to earnings reports so far this season. So, we got Netflix, and we jumped 20% in reaction to its numbers. We got Microsoft and PayPal, which skyrocketed on last Friday, but on average, the average stock that has reported earnings since earnings season began on October 11th actually has gained 0.22% on its earning reaction day, which is the first trading day following its report. If we will break it down, so while the average stock that has reported has gained 0.22% on its earning reaction day, a good chunk of stocks have posted big gains. So here's a list of the stocks that have reported this season that have gained more than 5% on their earnings reaction days. And as shown right now, VOXX take the leadership here with a gain of 49%, but it's a very cheap stock, only trading for a little bit over $2.50. If we will get to the big ones, and the NFLX of course is a member of the S&P 500, and we mentioned all the stocks here in the table that are part of the S&P 500, the big list of the American companies. So Netflix ranks second with a gain of 19.03%, and that is the top performing S&P 500 so far. Now we have also the other side, the other side of the moon, or the other side of the coin, and which are the worst performing stocks on earnings reaction day. Plenty of stocks have gotten hit on earnings as well this season, and this is a list of the stocks that have declined more than 5% on their earnings reaction days this season. Supreme Industries, STS, tops the list with a one-day decline of 21.52%, followed by Skechers, SKX, and in Steel, SKX posted its earnings on Friday, actually Thursday after hours, which means Skechers, the stock was reacting to this very, very ugly numbers on Friday, and it went down more than 16% in reaction. Alcoa, which is the first stock on report each earnings season, is also on this list with a decline of 11.42%. Alcoa is also a member of the S&P 500. Also, we got last week Intel and eBay, which missed estimates, and investors actually were acting furiously after their numbers. Microsoft was one notable large cap name that reacted positively to earnings last week on Friday, and the stock actually topped $60, taking out its prior all-time high from December 1999, and this is a long-term chart of Microsoft. While the company has paid out dividends during this period, it's hard to believe that Microsoft has been dead money for 16 years now during a span in which the S&P 500 is up 50%. Since Microsoft's last all-time high, 107 current members of the S&P 500 weren't even around in their current public form. That means they went into the stock market through an IPO. 56 companies since then in the index are up over 1,000%, so that is 10 times the price level of 1999, while just 51 of them are down. This is some astonishing numbers. Okay, let's see if Microsoft after this breakout can continue, can have some kind of a trajectory to the upside. And usually we do see this follow through. Just take a look on Netflix after the pop-up of 20%, and I know many traders are just looking on the first day reaction, but they fail to understand that this is just the beginning of huge money that is going to be injected into the stock. Lots of heavy funds are on the journey right now to put NFLX or the best performing stocks into their portfolios, and that means lots of money is going to be poured into these stocks, and that is the trajectory. That is the continuation, the follow through of the momentum to the upside. So just understand that if NFLX closed on its reaction day at $119, right now it's just 1 inch below the $130 mark, and the same could happen to Microsoft in the days to come, so watch it. As I mentioned earlier, the S&P 500, after it was making an all-time high in August, the S&P 500 has been unable to make any headway to the upside. It hasn't been selling off though either. In fact, over the last 48 trading days, and let's put the SPY on the chart. So since mid-August, in the last 48 trading days, the S&P 500 has traded within 3% of its closing all-time high on 18th of August. This is tied for the longest streak of trading within 3% of a 52 weeks high. Actually, since 1928, I can tell you that there have been only 4 other periods where we have seen a similar streak of 35 trading days or longer. Now, as we can see right now on this chart, and we just put all the statistics in one table, 3 of the 4 prior streaks were all broken to the upside, with the exception being the June 1991 occurrence. In 1965, 1992, and 2005, the S&P 500 actually initially broke out to the upside, but quickly corrected. In all 4 periods, 3 months return were mixed, but 6 and 12-month returns were generally higher. In all 4 periods, the maximum drawdown over the next year was less than 7%, and that is good numbers to hear. Okay. First of all, I want to talk today a little bit about the power of ignorance, and it's a good merit to be selective ignorance. Um, Trading and investing can be extremely complicated if we think about it. There are billions of dollars dedicated to every single aspect of the trading and investing process in hopes of finding an edge that will help us produce exceptional profits. High frequency trading and computer algorithms are as complex as rocket science or brain surgery in their quest for gains. So just understand what we are dealing against. While the market can be a widely complex endeavor, at the end of the day, all that any of us is trying to do is to catch a move in a stock. It may be, a 5%, a 5 cents profit in the course of seconds or millions of dollars over the course of 1 year or a couple of years, but all we want is a higher price. The mechanism for doing this can be very hard to fathom, and they tend to lead to the conclusion that complexity will lead to better results. The truth is that people tend to overthink the process. They are overwhelmed by the news flow, clever pundits, and predictions of all kinds. If the Fed does this, then it will lead to that, and we can make ginormous profits if we understand it correctly and make the right move at the right time. While the process may appear very complicated to others, traders and investors who do the best over a very long period of time tend to have fairly simple approaches. They have learned a process that works for them and they stick to it. They may adapt their methods from time to time, but the core of their success is simple and easy for them to understand. Warren Buffett is probably the best example for that. People today are still trying to fully understand how he evaluates potential investments, but for him, it is probably a pretty obvious methodology that is helped by the judgment he has developed over the years. We may not be able to duplicate it because it is a function of his way of thinking, and each one of us has a unique process of thinking, but you can bet that to him the process is pretty simple. Small individual investors and traders tend to think their lack of sophistication is a great handicap. This is often true simple because they don't realize that it is possible to keep things simple and still do quite well. If all you do is block out all the random noise out there, you are likely to make better decisions. You really don't need to know what is going on with Asian currencies or central banks in Europe to trade effectively. What you need to focus on is the manner in which a stock is moving and whether there is a likelihood it will continue to move the way you hope. Why it is moving isn't, particularly relevant. You are making money by a stock price moving from one spot to another spot, and the reason behind the curtain is totally irrelevant. One of my pet peeves is predictions, and you heard me a lot talking about that. Many market players have been fooled into thinking that they have to predict great future events in order to make money in the stock market. It serves the interests of money managers, writers, and pundits to promote this idea because, they are the ones who are always making these predictions. More than one investor has been convinced to turn his or her capital over to a money manager because the professional seems to have such great knowledge about the world affairs and insight into future events. I have found that predictions are great entertainment, and they can open your minds, to possibilities, but the better approach is to simply wait for the market to do something and then react to it. Money is lost much more easily by guessing the future than by reacting to the present. Investing and trading are always going to be presented as a highly complex and difficult because it serves the interests of investment professionals and the business media to do so. They want us to need their help. We may need some assistance in dealing with the market, but as Will Rogers said in 1929, don't gamble. Take all your savings and buy some good stock and hold it till it goes up, then sell it. If it doesn't go up, don't buy it. And the logic of that statement is questionable, but the idea behind it is really what the market is all about. We need to focus on stocks that are going up and ignore the million other things that complicate the task. We do have to predict the future to some degree, but we need not pretend we have psychic abilities. We don't. Watch for stocks that are going up and buy them. If they aren't go up, then don't buy them. Being ignorant isn't a good thing by itself, but choosing to not clutter your mind and your thinking with too much knowledge can help make you a better investor or trader. Selective ignorance is a great advantage when dealing with the market. Now I'm being asked a lot if I have some kind of advice or some kind of a secret sauce in order to prevail in investing or trading. And I would like to refer to that. Traders and investors are always looking for the magic formula that will produce steady profits. People like to believe that if they can figure out that one simple secret, they can sit back and enjoy steady gains forever. Some folks look for the secret to success in chart patterns. Others use fundamental analysis, and some apply computer programs. Sometimes it works and sometimes it doesn't, but the one constant there is that there is no magic formula that will guarantee regular success. If you want to make money in the market consistently, you have to work hard at it and be prepared constantly to adapt as conditions change. The market is dynamic, you have to be dynamic in your approach. There are plenty of platitudes that are quite obvious, but they most often are tautologies that provide little guidance. And one good example for that is the old adage, cut losses and let winners run. Cut losses and let winners run. And obviously, if you do just that, you can't help but to make money, but it is inevitable. But the far more important issue of that saying is, how exactly am I going to do that? How to do that? At what point do you actually take a loss? And how much room, how much space, how much tolerance do you give a stock to prove it's a winner? You don't want to cut losses too fast. The thing that works changes all the time. The minute you think you have the optimal formula, then market conditions are sure to change and to send you back to the desk to find a new formula, to assemble a new formula. One thing I found helpful in this quest for the magic formula is to focus more on risk rather than returns. And it is another trite sounding concept, but not losing money gives you a huge advantage. Let's think about it. Making up losses is hugely unproductive, and if you avoid that, then you are far ahead of the game. Many traders and investors like to focus on price targets. They don't want to think about what can go wrong with my position. They only want to think about what can go right and how much money they can make. I've always thought it illogical to use a set target in an environment when conditions change every day. But for many people, the dream of huge gains outcomes that logic. Rather than think about targets and the ultimate rewards, you are better served to think about risk and how to avoid losses. The rewards will take care of themselves if you are in the right stocks. It is failing to deal effectively with the bad stocks and bad decisions that can hurt you the most. There's no magic formula that will produce steady gains in the stock market, but focusing on risk and losses rather than targets and possible returns will put you on the right track. Trading and investing is so potentially lucrative because it isn't simple or easy. Once you recognize that and focus on controlling risk, you will be on the road to superior results. Okay. So let's continue. Okay, let's continue. And before getting to our stock picks of the week, and we'll see also what happened last week. You know, one line of Bob Dylan is running in my head right now. The only thing I knew how to do was to keep on keeping on like a bird that flew. And market players are still waiting right now for significant news that will pop the market out of its long trading range, but nothing in the headlines is producing sustained momentum. The economic news has been mixed lately, and that has resulted in a lack of clarity from central bankers. While the Fed is very likely to raise rates before the end of the year, probably in December, the rest of the world is still dealing with deflationary pressures and is in no hurry to make hawkish moves. The tendency of many market pundits is to make predictions about how this trading range is going to resolve itself. It is an easy thing to do and can make for an interesting column, but it is of little value to market participants who are trying to make money. Predictions about where this market is headed may sound smart and insightful, but the only way to really make some good money is to keep on slogging away and then react as conditions develop. It is human nature to look for simple solutions, and in the stock market there is nothing simpler than making a big call and then waiting for it to occur. It is inevitable that the market will eventually move in the direction that is predicted, but what isn't as inevitable is that you will make money. Timing is the key, and that is the major drawback and obstacle of all market predictions. If they don't have the timing correct, then the chances of making money decline significantly, and even making losses. The only effective way to deal with this trading range action right now is to keep on slogging away day after day. You have to remember that trading isn't a sprint. Trading is much more like a marathon to run. You will have good days, you will have bad days, but what matters most is that you will stick with it, and you keep looking for opportunities and setups that are part of your trading plan. If you don't understand that, there will be long periods of time when you don't make much progress. Then you will likely miss out when the opportunities do start to develop, do start to show up in the charts. The most successful traders are those that work at it steadily for long periods of time. There is no question that this trading range action we are dealing with right now is frustrating. There is limited opportunity for both market timers and stock pickers. It is tough to find tradable setups with momentum, but it is just plain ridiculous to try to predict market direction right now. And again, the best advice of the day comes from Dylan Lines. Keep on keeping on. Okay, let's gear up and see what we are going to see. What are we going to have this week? So first of all, this week we are going to get a flood of earnings reports and growth figures pertaining to the US economy, and that is something likely to add to confidence that the economy is growing, putting the final nail in the coffin for the earnings recession we had for the last four quarters. About a third of companies on the S&P 500 are expected to report this coming week, so just understand how busy this week is going to be. And we have the superstars, Apple, Amazon, and Google. Apple is going to deliver its earnings after the close of Tuesday, and then we are going to get the figures of Amazon and Google on Thursday. And of course, so this is going to be so Thursday actually is going to be the busiest day of the whole earnings season. Now, with the S&P 500 firms on track to see earnings growth after 4 consecutive quarters of declines, stocks will presumably be removing a significant obstacle which lets us see new highs on the horizon. This is what I think. The S&P 500 recorded its last historical high, as we saw earlier, here in mid-August, on the 15th of August, and despite months of falling earnings, even then, that have seemed to last an eternity. The index has traded down since then, even closing beneath the critical 50 days moving average for most of the last 6 weeks. The reason for the latest weakness is rooted in investor expectation that firm earnings would again drop for the 5 consecutive quarter and fail to rebound, which was the word on the street until last week. With that said, stronger than expected earnings numbers from top companies like Microsoft, we discussed it, and a very solid earnings round from the major banks like Bank of America, Morgan Stanley, Citigroup, and so on, turned everything around. And now the forecasts are for 1.1% growth in Q3, and probably until everything is said and done, at the end of the Q3 earnings season, we will get a growth of about 2.5%. In the event these numbers are what materializes, the market's earnings recession will be over for all intents and purposes. When you take earnings season numbers into account, which have been solid until now, and add to that the fact that the rate at which companies have managed to trounce forecasts has been particularly high to date this earnings season, that imparts all the more importance on further stock market movement. Chances so are much higher now that the market will break out will break up out of its trend range rather than break down, and my assessment being that we will see a breakup before the end of the year. The end of the year seasonality, which tends to shine its grace to investors, is also, on bull's side in the stock market, especially November and December. And after the 8th of November, also all the uncertainty regarding the presidential election is going to be in the rear mirror. Historical figures going back to 1980 show that average gains on the S&P 500 over the final 50 trading days of the year stand at 3.6%. And this is, comparable rise to be seen this year. That would lead the S&P 500 to close at 2,200 points level, around here on the SPY 220, and that is going to be above the all-time high. So this is something to take into consideration. Okay, let's finish this presentation by taking a look of our last week's picks, and then I'll share with you my stock picks for this week. So first of all, last week we had one long idea and one short idea. Both of them actually entered. TCK was the long idea above 1908, and actually that shined. That actually smiled to us very much. That was the trigger, and as you can see, it popped up on Monday and never looked back, and made us the week. Actually, it closed at 20.50, so this is about $1.50, which translates to about 7 to 8% pop in a TCK, which just continues its very long uptrend. The second one was on the short side, and that was Nike. Nike below 51.48. Okay, hopefully you saw my screen in TCK. So again, that was the breakout level, and this is the last week of trading. And let's go to Nike. So Nike, we wanted it below 51.48, and this is also entered as Nike just fell below the support level, but as you can see right now, it sustained its decline for only one day, going down a little bit over 50 cents from our entry point, but this was not enough, to take any money on it. And after it started to pull back, I needed to get out with a small loss. All right, let's see what we have for this week, and very good to stocks. First of all, FSLR looks great. Lots of short sellers in FSLR, which makes the case for a possible of a short squeeze. Should it leap over the obstacle of the $42.50 box. So this is our line in the sand, and we would like to join us. Just look on the last 3 days. This is a setup that we call a bull flag. So let's see if it can pass through the 42.50, and it can go higher very fast. The other one is TMH, and just look that in recent weeks we had a couple of pop-up, a couple of spikes, both in the price action and the volume below it, and right now it's consolidating around the highs at 41.20, and again we want to see a breakout of this tight range, and probably we can catch another spike to the upside, like the ones we have seen recently in the stock behavior. All right, Thank you all very much for being here with me. Hopefully this is useful information. Our intentions is just to give you the best information out there, and we are making a lot of efforts, we are making lots of analysis. You know, first of all, for us to prepare ourselves as traders, as active traders and investors, and of course also to serve you. So hopefully this is meaningful to you. My email, as always, is shlomo@trainer.com. Don't hesitate to drop me a line there if you want this presentation. If you want any recording, you are more than welcome to write me back. Have all a very, very successful week, and I'll see you later this week on Wednesday when we are launching the active trader course of the top trader. Thank you all very much. See you around. Bye bye.